Google grew 24%. Its stock still fell. This video explains that bill. Alphabet plans to spend up to $205 billion this year, spending that hit Google's own shareholders first, then lifted Asian chip stocks. Who really captures the value when the buyer writes the biggest check? First, look closely for operating weakness anywhere in this quarter's numbers. The real surprise is just how little of that weakness you will actually find. Alphabet brought in $119.8 billion this quarter. Sales grew 24% from a year earlier, marking 12 straight quarters of double-digit growth in a row. This was not one lucky product carrying the whole company for a single quarter. The official release described strength spread broadly across the business, which is a much harder trend to fake than a single standout division. Cloud was the acceleration engine here. Analysts expected $22.4 billion and 64% growth. Google delivered about $24.8 billion, up 82% instead. The dollar beat mattered on its own, but the larger surprise was the speed change inside a business already operating at massive scale. Accelerating growth at that size is rare, and it is exactly what shows up here. The cloud backlog reached $514 billion after rising by more than $50 billion sequentially in a single quarter. Cloud operating income topped $8 billion, with margin climbing from 20.7% to 35.6%. Growth was becoming more profitable here, not merely larger in raw dollar terms. A margin story sitting quietly underneath a headline growth story. Cloud's margin now sits ahead of the company average, a clear sign the business stopped being a subsidized side project. Put the scoreboard together. 24% company growth met 82% cloud growth, yet the stock fell after hours. That gap tells us the market did not reject Alphabet's products. It questioned how much cash those products now require. Now watch the profit headline break apart under a closer look. The cleaner, more honest number sits a little farther up the income statement than the one everyone quoted. Net income reached $112.1 billion this quarter, nearly 4 times the prior year result reported at this same point last year. On its face, that looks like the best quarter in the company's history. Read alone, that number makes Alphabet look transformed overnight. It was transformed on paper. The underlying operating business improved strongly, but it did not suddenly and genuinely quadruple in a single quarter. A $99 billion gain on equity securities drove most of that headline. The reported holdings included Anthropic and SpaceX investments. That gain did not come from another search ad or cloud contract. It came from marking investment stakes higher. Here is the profit number to trust for this story. Operating income rose 30% to $40.8 billion. Operating margin itself expanded 2 full percentage points to 34% company-wide. That still signals an excellent quarter. It also answers our first question. The business improved sharply. The near quadrupling belonged to investment marks. So the quarter was excellent, just not 4 times better. 30% operating growth supports the ascent. The securities gain inflated the altitude. Investors could celebrate the first number while discounting the second. Then the spending bill arrived. The first real crack in this story was not weakening demand at all. It was the rising price tag of actually supplying all that demand. Quarterly capital spending reached $44.9 billion, more than double the prior year level. CapEx means money spent on long-lived assets such as infrastructure. Alphabet is building before customers fully use that capacity. The revenue is visible today. Much of the return is not. That gap is the entire bet management is asking shareholders to make. Free cash flow shows the pressure plainly. A year earlier, the quarter produced $10.4 billion. This quarter, it was negative $5.9 billion. The bar crossed below zero even while revenue and operating income both surged at the same time. The growth stayed genuinely real. The spare cash simply disappeared. Then management lifted its full-year CapEx range. The old ceiling was $190 billion. The new ceiling became $205 billion, and public market reporting tied that update to a drop of nearly 5% after hours. Investors were repricing the size of the check itself here, not the underlying customer demand behind it, a distinction that matters a great deal for anyone trying to read this reaction correctly. This was an expectation collision. Revenue describes what Alphabet sold. Free cash flow reveals what it had left after investment. Alphabet looked like a landlord rebuilding every floor while tenants kept paying. The building is busy. The renovation bill still lands today. The funding plan also widened beyond operating cash. It paired $30 billion of underwritten offerings with a $40 billion market program. Berkshire Hathaway committed another $10 billion. That commitment split evenly. Class A was priced at $351.81. Class C was $348.20. Alphabet also borrowed in several currencies. A Canadian deal raised $8.5 billion across 4 series. Euro notes totaled 9 billion euros. A first yen deal reached 576.5 billion yen. This reads like a funding stack deliberately built for a long, multi-year construction cycle, not a single quarter's worth of spending needs. Spreading it across equity, dollar bonds, euro bonds, and a maple bond diversifies both currency risk and investor demand. Now flip the invoice over and look at the other side of it. Google's own expense line just became the chip industry's biggest demand signal. The market split almost immediately. Bloomberg reported that Asian semiconductor shares rose as Alphabet's spending plan renewed optimism around AI infrastructure. The same budget frightened the buyer's shareholders and encouraged the seller's shareholders. One number produced 2 opposite reactions because each side occupies a different place in the invoice. My read is that this is a timing trade. Investors can punish Alphabet for today's check while rewarding suppliers for tomorrow's orders. The buyer must prove a return later. The vendors only need those orders to arrive. Same budget, different clocks. Broadcom shows why this is not only an NVIDIA story. One report put Google at 13% of Broadcom's revenue. That dependency cuts both ways. Broadcom's fortunes are now tied to Google's own spending decisions. Google feeds its own custom chips into its cloud business. Yet, merchant silicon suppliers still collect a meaningful share of that same spending wave. 2 very different chip business models are being funded by the exact same wall of capital. Here is the reusable lesson. When a technology buyer raises capital spending, separate the payer from the recipients. At a $205 billion ceiling, Alphabet carries execution risk. Suppliers receive a demand signal. Strong end demand can support both businesses while their stocks move in opposite directions. So who holds the near-term leverage? The suppliers. Google pays now and must prove the return later. The same bill can hurt the payer and reward the vendor. Next, watch our documentary on MU.